Hi, welcome back to You Heard It From a CFP. My name is Matthew Coyle. I'm Director of Financial Planning here with Advanced Capital Group in Minneapolis. A lot going on. It's been a couple weeks since I've been with you, so let's dive in because we've got some things to talk about, a down market, what to do, what to be thinking about. Let's dive in. Well, thanks again for being here. This is episode 44 of You Heard It From a CFP, and today we're going to talk about market declines and what to do during market declines. You know, I say all the time at the end of my videos, I do appreciate your time. It's your most valuable asset. I really do mean that. I do appreciate you guys watching these videos. I do appreciate the fact you come here and spend maybe upwards of 10 minutes with me just listening to me talking to myself and talking to a phone that really can't talk back. So I hope the market goes up sooner rather than later, simply because I'd love to explore some other topics. But let's talk about market declines, how to frame it in your mind and how to frame it in the context of history, and how to talk about this with yourself and really kind of circle the wagons of what you should be doing, so to speak, in a market decline and how you should be thinking about this. So let's look at a few things, and we'll take a look at a couple, starting with where we stand now. Worst stock market start to the year for a year since 1939, not good. Bigger disappointment though really is the bond market, not surprising with rates going up as much as they have since late November. All right, so whether you're managing your own money or having someone do it for you, there is a very uniqueness to this environment we're in right now, which is kind of a stagflationary environment, but without the stag part, because companies seem to be doing okay and people are going back to work, but inflation is still a problem for other reasons. So I guess I'm just going to call it that. I'm just going to call it Flation, which makes, I guess, more sense. But anyway, if we're in the middle of inflation, what do you do with your money? Some ideas to put money in different places or others. If you're committed to stock market long term, stay where you are. If you like your investments, hold on to them. If you're not and you are coming up on a particular date, whether it's retirement or big purchases, and you have to make a decision on what to do with money, where do you go if you can't handle the volatility of the market right now, and what has a good history of demonstrating that it can handle that? Three things that a lot of people will rotate to in the times of high inflation that can offer you some protection during these times, but sometimes it's a relatively short-term protection and they have underperformed in the past. So let's take a look at three of them: dividend-paying equities, inflation-adjusted bonds, or let's just use TIPS as a marker for that. Okay, Treasury inflation-protected securities, or TIPS. And another one that you may not consider actually, but if you already have one, you may want to consider it: whole life insurance policies. So if you're really worried about inflation, there's three things you can take a look at. But let's start with dividend-paying equities. First of all, and I'll just throw these up on my screen. Why are dividend-paying equities important? Well, dividends are important actually in the overall investment picture of stocks because they do represent a good portion of your long-term return. This particular chart comes from Fidelity. Actually, the data comes from Morningstar, but Fidelity is reproducing it. And it's about 40% of your long-term return, if you're a long-term investor, can come from dividends. So dividends are very important. They can account for a very large portion of your stock returns over time, and then the reinvestments on those dividends, so kind of reinvestments, growth on the growth on the growth, that can amount to somewhere in the neighborhood of 30 to 50%. Most people peg it around 40. Morningstar has it around 40, and of course Fidelity is quoting that as well. So that's not any different from most of the research I've ever seen on dividend equities. They are important. Now, whether they handle times of inflation is a relatively short phenomenon, tends to be. Now, I'll throw up this next chart. Relative performance. Now, what you're looking at here are 25%, 25%, 25%, 25%. So quartiles, the top quartile, the top 25% of dividend-paying equities in the market tend to outperform relative to inflation, okay, by a means of on average about 3%. So what you're looking at here shows a relative performance versus inflation of the highest dividend-paying equities in the S&P 500. Now that's over 12-month quartiles, okay? So it's relatively short term. If you would have done that, just invested in dividend-paying equities over the longer time, let's say you had invested in just a few high dividend ETFs, and I can throw one up on the screen here, your underperformance versus growth is fairly noticeable. So it's not necessarily a long-term relationship that you see, but in the short term, you really have to go somewhere and you're afraid of anything else. There is a short-term demonstrated 12-month versus inflation, let's call it relationship, where they do outperform inflation on average. No promises, and I'm not going to endorse any one or the other, but you can look at a general, and I'll put a chart up here if you want to see one, but it's not an endorsement of any particular ETF or fund. The next one we'll go to is TIPS, okay, or Treasury inflation protected securities. And what we'll do is we'll look at this first chart, which is one of the easiest way to invest in these things is through an ETF called TIP. It trades on the ticker TIP. It's the Ishares TIPS bond ETF. This is not an endorsement to buy TIPS at all. I'm just saying this is what the demonstrated relationship has been. In the short term, just taking a balanced portfolio this year, a 60-40 balanced portfolio similar to the Vanguard Balanced Index, and that's what I'm quoting here, versus the TIPS bond fund, it doesn't eliminate your chance for loss by investing in Treasury inflation protected securities, or TIPS, but these particular securities did limit the risk and they did limit the downside. Okay. Now the problem is when you back out over the long term, even versus the same balance fund, they don't provide over the long term outperformance, and they don't really reduce your risk that much relative to the outperformance that you get from the balance fund. So historically, investing in Treasury inflation protection securities, TIPS, inflation adjusted bonds, it can be a good inflation hedge in the short term. These hedges tend to be short. They don't tend to work in the long term because inflation tends to be short. So what I would do is, if this fits in your overall portfolio, again, it's not an endorsement of these two funds specifically, I just pulled them because they're good examples. But in the long run, if this fits in your financial plan for you and fits your goals, it might be something to consider even though it's not an endorsement. The final thing you might want to look at, and it's a bit of an oddball, is whole life insurance, actually. Whole life insurance can be an inflation hedge, believe it or not, and the reason inflation adjustments or inflation hedges happen inside whole life insurance policies, I'm not talking variable life, I'm not talking universal life, I'm not talking term insurance, I'm not talking any hybrid investment, I'm talking pure traditional whole life insurance, okay? I have a couple, I know many people that do. Every time you put a premium into your whole life insurance policy, there is a jump in the cash value that's contracted over time, and it rises as the policy ages. The cash value rises by a certain degree toward a maturity date in the future, which is typically at least age 100. But it forces, it's a forced inflation hedge, so that your money, more of your money grows over time in cash value relative to inflation versus other investments you can have. Again, this is a long-term investment. It must fit your financial plan if you're going to use it. I do tell clients from time to time that if they have an existing whole life insurance policy and they absolutely do not want to be in the market whatsoever, and they just want to look at something that's safe and will have some type of return in the short term on it, you can overfund or max, what are called max fund, whole life insurance policies if it fits your financial plan and if you have room to do it. And there is a way to build whole life insurance policies to do this specifically. We teach people how to do it. If you want information on it, you can reach out. We don't sell policies, but we can teach you how to do it. So having a whole life cash value inside your policy can actually act as an inflation hedge. And as rates rise, it tends to help insurance companies a little bit just because their portfolios are invested are always investing in new bonds that come out to the market, and they're making more money on their payments from the coupons. So it can act as an inflation hedge. You might want to look to overfunding an existing policy you have, but those are three things you could look at in the short term relatively. Dividend paying equities, high dividend paying equities, TIPS, and of course traditional whole life insurance. They do provide some type of an inflation hedge in the short term, a little bit of protection, but in the long term, it better fits your financial plan if you're going to use them. So I'm going to leave it at that. If you have questions on this material, please reach out to me and we can flesh it out a little bit further. In the meantime, as I always say, your most valuable asset is your time. Thank you for sharing yours with mine. I do appreciate it. And good luck to you, and I will see you next time. Thanks.